Hi guys, welcome to Speed Session with Galgal. This episode is going to be a capital markets masterclass. It's going to be a power pack of information. We have two very important guests with us today, Mr. Hemant Gadodia sir and Mr. Kunal Bora. So welcome to the podcast guys.
Thank you.
Thank you.
So I would like to start with you, and if you could just briefly introduce yourself to the audience.
Yeah, sure. Thank you for having me here. I'm Hemant and I've been a banker all my life. I worked with banks like ING, Standard Chartered for a brief period of time. But most of my career I've spent with Citi, handling the corporate space. But you know, the emerging corporates and the mid-market we used to call, which is what the mid-caps you say in capital markets jargon. And since Citi was a universal bank, we covered the entire spectrum of services which a bank offered to these corporates, and that is when I started getting interested, or I started understanding how good promoters, good companies create so much value, sustainable value for their shareholders over a period of time. And that is what made me quit the bank in 21 and to start my own boutique investment bank, where I help corporates today raise equity, advise them on going public, and see how their governance structures can be improved. I know one thing, that if good promoters are given the right guidance, right advice, they will go on to create a lot of value, because there are so many tailwinds which this country is offering them across industries. So good promoters need the right guidance, right handholding, because they know their business very well. You don't need to teach them their business, right? They need guidance around this entire capital markets, equity raise, building the right governance structures, building the right compliance framework, right communication to the shareholders. If you can help them in that part, over the next 7-8 years, we will bring many good companies on the public platform and help them create value for the shareholders and of course for themselves also, because the largest beneficiary of any value creation are the owners themselves, because they continue to own a majority of the shares. It's just that they need the right hand holding.
Kunal, how about yourself?
So, largely over the last 2 years, I've been a private equity investor, and I'm overseeing my family office's investments across all sort of asset classes, whether that's real estate, whether that's equity markets, listed or unlisted for that matter. And in a sense, I mean, private equity would be a very sort of broad term to use, but what we essentially do is that we handhold, nurture, sort of grow a company from, to a certain level, where the company starts to mature in every aspect of the business. And then it's time to create value for external shareholders. So that's when we take the company to listing. So it's a whole process, I would say, from sort of right from putting your capital into the company when it is unlisted or when it is private, and then going through that journey with the company, with the founders of the company, to listing and beyond. So I never really track the stock market on a daily basis, even though I'm in the business. That's because the horizon at which we deal with is over 5 years. So for me, looking at the stock price every day, really makes no difference. If I believe in a story, or if we have 100% conviction in something, we stick with the company through thick and thin, and we take that company to a certain size. And of course, not every company is going to turn out to be a good investment. There'll be 10 companies out of which probably 2 or 3 have done superbly well, 2 or 3 are average, and 3 to 4 are not going to do well. So the objective in what I do is really to help these companies grow, to give them a new sort of way to growth, inorganic or organic, help them strategically, help them get sort of work orders, help them with their working capital requirements, help them with the corporate governance that they need to have in the company. And this is a part of what I do and what I oversee.
Thank you for that. So today we're going to dive into capital markets, right? So Can we start with the basics? What are the key roles and responsibilities of the organizations involved, from investment banks to NBFCs to investors? How does this ecosystem work?
Or what's even the difference between an investment bank and a traditional bank?
Okay. So, see, the backbone of financing in any country is the banks, right? Banks have multiple divisions, right? I mean, you have a retail division where they deal with an individual client, right? Where they offer them all kinds of services of taking deposits, offering them services like savings account. If it's a company, then a current account, and then extending them loans for various needs of a retail guy. For example, a personal loan or a car loan or a bike loan or a housing loan. Then you have a corporate banking division, right, which some banks classify within that corporate banking division as SME division or commercial bank or mid markets or large corporates, but largely overall it's a corporate banking division where within that division banks deal with largely the corporates, right, extending them all kinds of services. Some banks are universal in nature, wherein they extend the entire spectrum of services. So from plain vanilla working capital financing to financing their capex, to help them advisory regarding possible M&As, advisory regarding IPOs, in case they have a merchant banking division of their own. And then there is investment banking and wealth management, divisions of the bank. Wealth management is the fastest growing division for any enterprise today, because the way the country is growing, there are so many needs today happening with not only a retail investor but for HNIs, ultra HNIs, and that's why within wealth management you have another offshoot of that as a private banking division, which the banks have opened to cater to the HNIs and the ultra HNIs. And for retail investors, banks have their wealth management division. Whichever banks have a large merchant banking division also, they get involved to do a lot of work for the corporates. And if you see the way capital markets in India have deepened over the last 5-6 years, the fundraising activity has only ballooned, has only shot up, and I think in the coming years it will further increase. I mean, just to give you an idea, SME as a segment, which was such a small segment, where the entire market capitalization of all companies 5-6 years ago was 10,000 crores, those companies have raised 5,500 crore from IPOs this year, where the entire market capitalization was just 10,000 crores, which is now at least 12-14 times of that. So every division of capital market has kind of become much larger, much bigger than what it was a few years ago. And the way country is growing, the way our GDP is growing, the way there are multiple tailwinds across so many industries, I'm sure things will only become bigger from here. But the only thing we have to be cognizant, and which probably we'll discuss as you go along this conversation, is that there are risks involved in capital markets. Yeah. The idea of this conversation, I'm sure, is to make a small investor, a retail investor on the street, aware about what capital markets are, the jargons, the insights about what things are all about, how things should be. So we have to be very cognizant of the risks involved here and how you can manage those risks well and still grow your wealth sustainably.
Great, sir. Kunal, you mentioned you're into private equity, right? If you can break down what exactly is private equity.
So private equity essentially is investing in unlisted companies. Before a company has to go public, or before a company has to take that leap to enter public markets, a company still needs capital, right? Whether that is for any capex, whether that is for working capital, all sorts of business needs that are there, acquisitions. So any of these needs that are there, they require capital financing. So that's where private equity comes in, and essentially that's about. And then how an exit works within private equity is also very important, because large private equity firms in the world, when they invest in a particular company, they have a roadmap up to the exit. Now the exit is usually, in more cases than not, is an IPO, which is to take the company public. But the reason why companies require private equity financing is because not every company already has the tools to go public. So there is that certain period that you require before a company can really go public, and that's why private equity investing plays a huge role in helping companies grow.
Got it.
This trend has become more popular in the recent times. Till 5, 6, 7 years ago, smaller companies had forget about access to private capital. They didn't even have access to public capital. But the way things are growing today, more and more investors, large investors, are willing to take a bet on the company even before it goes public, right? So they would have comfort and faith on their business model, and of course the assurance that the company will go public soon. And hence there's a very large amount of capital willing to be deployed in companies which are about to go IPO. So that's another area which is growing very fast.
Is it because the whole India story is blossoming so beautifully and the investors are more and more bullish on not just the established institutions but also the smaller players who are coming across in say tier 2, tier 3 areas of the country? Is that the main driving force behind this?
Of course. So what is the country's growth? Second is capital markets which are so linked to the country's growth. They are all doing well. And now what's happening is that the larger investors, we are talking about the HNIs and the family offices, have become more patient in their approach, right? So they're willing to take a 2, 3, 4 year bet on a company. They're willing to invest today, see the company go public in a year's time. Again, anyways, in SME they have a 1 year lock-in, in main board they have 6 months lock-in. But forget about the lock-in. Despite listing, they are willing to wait for another 2, 3 years, see how the promoters are able to grow the business post capital raise, post equity raise. How they are able to deploy that amount profitably in a better way and sustain their already efficient businesses which were there when they took them public. So the point today is that there is a very good amount of capital which is willing to bet on these companies even before the IPO, which is a trend which was seen only in larger companies. The proper private equity firms which used to cut few $100 million checks earlier. So this segment was a very, very limited segment earlier. Now what's happening is that you can raise even $2-3 million in a company before the IPO, which was not the trend. Till 5-6 years ago, you would hardly see any such instance. But now you see so many companies which are going IPO, whether SME or main board. You would see so many of them as you read their DRHPs, you would see so many of them which have raised capital 6 months before, 9 months before, 12 months before their IPOs, right? That's a very powerful trend because it gives so much comfort to the owners of the company. End of the day, it's a growth capital. If a management, if the owners of the company have plans, vision to, raise capital and quickly fast track that growth, there is capital willing today to back them, which was not the case earlier.
And an important point here also is that, for an outsider listening to this, maybe, it would look like private equity investing, looks all great and rosy, but it comes with its own risks, because when you invest in a company which is private, there could be n number of things that could also go wrong tomorrow if the company doesn't list. If it has any kind of, there's no way to really sell your shares. When you're investing in a public stock, it's a liquid market.
At least profit loss you can sell.
So there are sellers and buyers in the market. It's a marketplace. For a private company, there's a reason why private equity firms also manage to buy these stakes at cheaper valuations or sort of reasonable valuations, is because they take that first leap of faith in the company. That investor has to be rewarded well when it comes to IPO, because they are showing that faith when nobody is willing to show that faith in the company. So that risk that is there from investing in the company when it is private and until you take it public is pretty high. There's no fallback option for the money that you are investing, other than figure if the company gets acquired, well and good, sure. But if it has to go to IPO, there's a lot of hurdles you have to cross to get to that IPO stage, whether it is SME or main board. So private equity investing does come with its own risks. It's not as straightforward as it might seem.
So this is not private equity in the traditional sense.
Yes.
Private equity means a certain set of private equity firms which are taking a board seat or putting larger amount, cutting bigger checks. It's not that. It's like you can call it pre-IPO investing or an unlisted investing, where a group of HNIs sometimes, or sometimes 1 or 2 large anchors come and put in the checks. The fundraise can be $2 million, $3 million, $4 million. It's a very small amount. That too, a group of HNIs come and invest, right? So each individual may cut a check as small as $100,000 or sometimes even lower, right? But collectively they put $2, $3, $4, $5 million in a company before the IPO. the good part of this approach is that it gives so much confidence to the owners and the management, right? There are people willing to back us even before we are going public, right? And then it becomes in everybody's interest, right, to take the company public sooner.
Yeah.
And another thing to add here is also that, a very important part of this private equity investing is that if your intent is to take a company to IPO, as an investor who invests in an unlisted company first and then takes that to listing, you're locked in for a certain period of time. So, like Sir said, it gives a lot of confidence to the company, to the promoters, that there are investors who are willing to back us, and not just back us in the short term. These are investors who are very well informed that their investments will only be realized after a certain number of years, which is 2 years, 3 years.
Bare minimum is 2 years, right? I mean, certain time to take it public and then certain lock-in period. So practically they can't exit before 2 years. So they are anyways taking a long-term
bet. Yes. So I think that's a very important point to know as well.
See, you can grow your enterprise up to a point with the support of debt, right? I mean, you grow your capital as 3 forms, right? It can be in the form of debt, it can be in the form of equity. Today there are structures in between them also, but let's broadly classify them in 3 parts: debt, equity, and your own internal accruals, right? I truly believe, since I was a banker, debt always has to be like salt in the food, right? Debt cannot be a large part of your balance sheet. If that happens, I have seen so many of the companies just destroy themselves. So which are the other 2 components of capital which help you grow sustainably? So it's all about sustainable growth, right? Growth cannot be haphazard. It cannot be too volatile. The underlying valuations can be volatile, but the growth of the balance sheet and the companies has to be sustainable. For that to happen, you need equity capital and you need sustained earnings redeployment in the business. Earnings get redeployed to the extent they are growing, right? So if a company is having a top line of, let's say, $100 million and it's earning $10 million, it can only redeploy that in its business. Right. But what if the opportunities are very large? What if there are multiple opportunities staring at them to capture? That is why the role of capital market comes in. Till a decade ago, our capital markets were not that evolved, were not that supportive of, let's say, smaller businesses. But that's not the case today, right? I mean, Indian capital markets have come a long way. And today, as you are seeing, the markets, as you are seeing fresh issuances, smallest of the companies are coming to the public domain to raise money, right? Yeah. Will all of them create value? No, definitely no. But good businesses, good promoters who are raising quality capital today, and they are going on to deploy it in a manner that they can generate a good return on that capital employed, will definitely create value. So the idea is to back as many of them as we can. All of them will not create value, but at a basket level, I think a huge value can be created.
Just to touch upon what Sir also said, I mean, it's not always that a company only needs capital to grow. There's a lot of things outside of just pure capital that is required. So you can grow up to a certain point with capital, but how you drive the company towards that growth strategically, how you plan out for the near future, for the sort of long-term future, is very important in how a company grows. There are, like he mentioned, there are a lot of companies who have absolutely destroyed value, by taking on excess capital. So a lot of times the problem isn't raising capital. The problem is how to deploy that capital. And if you don't deploy that capital in the right way, there's only one place, the company is going to go, which is downhill. So I think that's a very, very important point in terms of what helps a company grow as well.
In this point, the governance will play a very crucial role, right?
Very large role, and that is an area where smaller companies are lacking. When I say smaller, so okay, for our conversation, we will define companies as smaller, which are less than 1,000 crores in top line, or let's say 1,000 crore in value, right? I mean, just for our sake of discussion. So in those companies, just to answer you, governance is an area which needs to be significantly improved. I would not say it's bad, I would say it's lacking, right? So those promoters have built the companies, practically as a one-man show along with their team, right? They are the sole decision makers. They have decided the growth trajectory. They have decided the capital allocations. They have not been in public domain, so they have not really been into compliances. As these companies mature, become larger, come into public scrutiny, public glare, it's very important to have a right governance structure, which is not there today. It's not there. It's not that it's good or bad. It's just not there.
I didn't want to drop any names of the companies, but over the last few years, we've seen a lot of governance issues, and that's why.
Yes, and that is where roles of market participant like us also come in. A right advisor would always want to give an advice just beyond monetary terms, right? So the advice doesn't really range with what should be your valuation and how much money you should raise. The advice also ranges from what kind of setup you need, what kind of independent directors you need on the board, what kind of policies you should have so that tomorrow none of your compliances lapses are there, what kind of the team in your financial secretarial divisions you should create, how you should monitor the way you're monitoring your business, how you should monitor these aspects also, that tomorrow there is no question on your compliances or the way you are governing your company, right? So for example, all disclosures, for example, any kind of share, sell or buy happens, let's say with the promoter group, how they are disclosed on time, how every material event gets reported on time. There are so many areas which today they are not aware of, right? I mean, obviously they would have all the right intent, but they may not be aware of a lot of these areas, which again needs to be covered. So governance is something which is very holistic. It's just not about one point.
Yeah. So, and to appreciate the present, like this ecosystem that you mentioned, that right now there are a lot of companies and individuals that can advise a company on what the next step forward is. But taking it in the early days, during the 90s, what did that scenario look like? How was the whole financial market, capital market ecosystem during that phase of India?
India was very small at that point of time, right? Small in the sense that, our capital markets obviously were less than $1 trillion in total value. The value is north of $4 trillion today, right? 4.2, 4.3 would be our current total market capitalization. Now, during those times, obviously the number of companies were also lesser. More importantly, those were the times where governance was not so much emphasized upon, because this current ecosystem was being created, right? I mean, our regulatory setup,
Correct. SEBI,
the largest exchange, which has been, which is now kind of among the world's largest exchanges. It all got set up during the 90s, right? So before that time, obviously, things were not that, the framework was not there, the governance frameworks were not there, the watchdogs were not there. To the extent they are there today. I mean, the securities market was overseen by entities which are not dedicated to securities markets regulation. There was once one large stock exchange which was not really having that kind of an independent setup to really govern its lot of entities coming in it. Obviously, the country was experiencing a very high level of growth after it was deregulated. After our then finance minister had deregulated the entire markets and the economy, and that is when the need was felt that once the markets are deregulated, the economy is deregulated, lot more capital will flow in, lot more enterprises will start growing fast, lot more promoters will become more ambitious, and that was the time when all these structures came into place. And I think they've done a wonderful job in creating the whole ecosystem in a manner that investors can now happily focus on identifying growth stories and invest, rather than worrying about whether their shares have come in or whether there is some bad delivery or whether their payment is coming on time, because there used to be weekly settlements and all that. At least all that, I think the horrors of those days, we are past it, right? And I think the current set of investors need to be very thankful of the entire regulatory structure, because these are some of the issues which used to take so much time and energy and bandwidth of investors at that time. These are things of the past. We need not worry about counterparty risk today, right? Because the exchange is taken care of. If you have bought a share, it will come in your demat for sure.
Correct.
If you have sold a share, you will get your money for sure.
Yeah.
So those counterparty risks and all have all been taken care of, right? Which was not the case.
We take it for granted now.
We are taking for granted now, right? So imagine how much comfort our regulators has provided us over the last 2 decades.
And this is a very fair point also, because in terms of settlements, for example, so SEBI has now, introduced the T+0 framework where settlements are going to happen, which is optional, but I think it will be adopted pretty quickly, because whichever brokerage or whichever sort of market player does not adopt that, people are going to shift. Like you want your money on time, you want settlements to happen on time. And the regulators played a very large role in making these things happen. Of course, along with the other issues, which are dematerialization of securities and all of these other things. But I mean, the regulator has played a large role in sort of, making the entire investing process friction free, so it helps a lot.
You think this is also because in recent times there has been a huge influx of investors in the Indian market, like especially addressing like the boom that we saw during COVID? If you want to touch upon that bit, like how did that change the whole Indian capital markets?
So in essence, what happened is, after COVID happened, it was like a big shock to everybody. When COVID happened, nobody in any part of the world knew how all of this works. The last pandemic that happened was probably 100 years ago during the Spanish flu.
Correct.
So this was a new situation for everybody. Now, in terms of sort of the global uncertainties or any of those issues are related, I think the world really realized that they are heavily dependent on China. So any product that you use today, anything, something or the other had something to do with China. And when COVID happened, when this realization came, which is when there was a need for China plus one. The plus one being another large growing economy which has a huge labor force, which has the potential to provide that kind of output in terms of supply chain all over the world. So that's where India really, firmed its position, which was being the China plus one. So slowly the muck out of China started moving into India. I would say muck because one sector, for everything there was a substitute now. What was happening in China started happening in India. So COVID really, helped India in that sense, I would say, where the world realized how much they need India for that matter. And the economic boom after that, like in terms of the manufacturing potential of the country, has been phenomenal. Additionally, what supported all of this was access to capital. So in the past, if SME, MSME for that matter, had to raise capital, there was only one way. You go to the bank, you provide some collateral, you get a loan, you get your working capital facilities. This was the only way that SMEs or MSMEs would raise capital in the past, and that also was pretty difficult. Indian banking has not always been very smooth in terms of providing that kind of capital. So the access to capital, more so after COVID, increased quite a bit with an influx of investors from the other parts of the world, whether those are funds, whether those are sovereign funds, whether those are any kind of hedge funds for that matter. People started entering Indian markets, and that really gave a rise to sort of Indian capital markets as well. If you see in terms of statistics, in India in January 2021, 3 years back if we go, January 2021, the SIP, a total SIP per month in India was around 8,500 crores. Fast forward to March 2024, we're looking at about 19,500 to 20,000 crores in SIP every month. So, and that's just in a span of 3 years. So that pretty much tells you, how much participation has increased in capital markets, how people are starting to believe more and more in Indian markets and in Indian equity markets. And this entire theme which played out, which was the China plus one theme, has really helped India in that sense. At the end of the day, before I conclude on this point, at the end of the day, I mean, SMEs or MSMEs, these small businesses are the backbone of the country. So these small companies coming out of, all parts of the country are really going to be essential in achieving that 7 trillion, 6 trillion, 7 trillion figure that Sir mentioned. SMEs contribute about 30% GVA to GDP. So GVA is gross value added to the GDP of India. So 30% of the contribution to the GDP comes from SMEs, which is why it is, these small businesses are really going to play a big pivotal part in sort of reshaping the economy and taking it to a different height.
I agree. And now, in a situation when a SME approaches you and you want to add that influx of capital to that company, I want either one of you to break down what are the starting points of this journey and what the journey looks like. Like when a hypothetical company has approached you and say that, hey Kunal, I need to raise funds, I might even want to go public. What does the journey start with and look like?
Initially, the first thing is to understand and analyze the company, right? I mean, which again has to be a fairly detailed one. It starts from understanding the business, the various drivers of business, where they are standing, why do they think that they have growth parameters ahead, how their entire environment is shaping up, who would be their peers, and then you try to understand what is the competitiveness of the business which they have built, which is again reflected in the margins of the business, who would be their suppliers, who would be their key clients, how their clients are looking at this entity. You need to do a little bit of a forensics here. You need to do a little bit of scuttlebutt here, in the sense that you have to understand from the market, how the market thinks about the
Market
entity,
sentiment.
right? There, I mean, people around them, what's their view on the company? Who are their bankers? It's extremely important, who are the bankers? How much is because that itself gives you a lot of comfort and discomfort, right? A good bank in the company means that, those banks have done their homework, right, before lending them.
So in a scenario, if the company is a startup and doesn't have any prominent bankers or investors backing it, in that situation,
see, that is a very different form of fundraising which we are talking of, right? When you are talking of equity fundraising for startups, it's an entirely different model. You are talking of VC kind of an investing. You are talking of an investing where you are looking at either your money becoming multiple times in a short span of time, or there's a risk of the startup not scaling up and your money not kind of giving you the return, or not even coming back in its entirety to you, right? We are talking of a space where a more matured space, where we are talking of enterprises which have built a certain scale. Let's say 200 crores of top line, right? Or let's say 250 crores of top line. But then they see a long runway, and then the promoter, let's say, believes that in the next 3, 4, 5, 6 years, the company can grow 15-20% organically on its own in the setup it has created for itself. But if it is given external capital, equity capital, the growth rates can move from 15-20% to, let's say, north of 25-30%. That's CAGR. That's very high. 24% CAGR would double their base in 3 years, right? 30-35% CAGR, 36% CAGR doubles their base in 2 years. So when a promoter is very confident that on its own it can grow at a certain rate, 15, 20, 17, 18, 20%, but with the help of additional capital, the growth rates can be much faster. See, they can go for large capex, they can go for new product development, they can go inorganic, they can acquire some of the smaller peers. There can be multiple triggers for a faster growth. And if your homework tells, if your scuttlebutt, if your own forensics tells that yes, the company is in the right space, the company is positioned well, and it can move on it can change its orbit, how we call it, right? Then you back them. So then you start, you create the entire participant network to take the company public. In the meanwhile, many a times promoters see immediate deployment of capital. They see opportunities. Let's say they have to start a capex. The going public takes a bit of a time, so you can raise some amount of capital for them quickly in the what we call it pre-IPO, right? A small portion, small part of the overall IPO as a pre-IPO capital for them to fast track their growth, right? They can immediately order the machineries or give orders to contractors for building the the entire sheds and all. Or if they are targeting an inorganic growth, they can start a dialogue with some of the potential sellers immediately, or they can slightly deleverage themselves if at all there is leverage ahead. First of all, I don't think that leverage companies can create any sustainable value in the market unless there is a clear growth path, unless there is a clear path to deleveraging, right? Equity capital is not a cheap capital, right? I mean, equity is an expensive form of capital. So end of the day, it has to be used to generate higher returns, right? Equity capital can not only be used, should not only be used to deleverage, right? I mean, partly yes, in case you have to. In case, we have to see what is the debt equity, debt EBITDA, different parameters we see to assess the leverage in the entity. But in case that, the leverage is not too high, ideally, the equity capital raised should be utilized to generate higher returns on capital. So ROCE, if the money can be used to generate a 20-25% ROCE, right, or north of 20% ROE from the redeployment, that's better rather than just repaying it and reduce your interest cost, which can probably save you 10% or 9% or thereabouts. That should only be done when your leverage is very high, which is actually not creating equity value for you. End of the day, enterprise value minus debt is equity value, right? So if your debt is too much, you yourself are hurting your equity value and the investor's interest also, right? One thing is for sure, if any entity continues to remain deleveraged for a long period of time, you can do any kind of homework and see that those entities don't create sustainable equity value also over that period of time. So leverage has to be absolutely controlled. This is what I believe, and leverage has to be seen in the context of what is the net worth of that entity, which is what I said, that equity. It has to be seen in the context of the value add which the business generates, which is measured in terms of EBITDA percentage, right? So again, leverage has to be seen in terms of how much is the total debt in the company vis-a-vis the EBITDA which the company is generating.
Kunal, do you have anything to add more?
So, of course, I mean, Hemant sir touched upon all the important points in terms of, what do you look at technically, what do you look at, how do you look at sectors when you analyze a company, or what the industry growth is expected to be. What I would like to add is that the first thing that we look at as a family office who would invest in private companies is the quality of a promoter. So what that means is that if you have a great company but a average promoter, it is less likely to succeed than having a great promoter and an average company.
Okay.
So every business has upturns and downturns, up cycles, down cycles. It's not every day is the same in running any kind of enterprise. But the intent of the promoter is what matters the most. Whether they have the mettle to face, any sort of adversity that comes in the business, any sort of sector downturns that come in, in that particular sector or that business. And if they do, that means they can withstand any kind of, any kind of difficulty that could arise in a business. So I think the quality of a promoter is just as important, if not more important, than the actual fundamentals of the business.
Fair point. And I feel like any company or any entrepreneur listening to these points of the analysis bit, it's very important for them to consider all these different points that both of you listed out, because every company who wants to be listed has that aspiration that, okay, one day I want to be on the stock list exchange, but they have to complete this homework first before even approaching or even dreaming about that dream. But once this analysis is complete, what is the next step in the IPO journey of a company?
So you formalize the arrangement with the company that, they have to go public. You explain them everything, the timelines, the process, the cost structures, and then you go on to create the entire ecosystem.
What is an approximate timeline, sir, for this?
Okay, so depending on whether the IPO will be main board or SME, the timelines differ. For main board IPO, timelines are slightly bigger. They could be, let's say, a year plus. But for SME, assuming the clients information flow is very good, and they are able to provide all the required data, info, documents, everything on time, it could be as less as 6 to 8 months also, 6 to 9 months, let's say.
SMEs, it is become relatively very easy now to list, also because how well the platforms have been built by both the exchanges, the National Stock Exchange and the Bombay Stock Exchange. And they have a large role to play in this in terms of providing this kind of equity capital to all of these SMEs. So timeline for SMEs, like sir said, up to 6 months. If from today you start, working with a company, you can aim to list the company within 6 to 8 months time. In fact, there have been occurrences where companies have gotten listed in 3 months time. But that again all depends, like sir said, on how forthcoming the promoters of the company are, how quickly data is being received by the bankers or whoever. So what happens is that an important point to mention here is that before listing or when you go for listing, there's a document which is prepared, which is submitted to the exchanges for approval, which is called a DRHP, which is a draft red herring prospectus. This prospectus is basically everything about the company from day one of its inception. Everything, like there's not one part that is missed. All kinds of disclosures, whatever the company has gone through in its history comes into the DRHP, and this DRHP is produced on the basis of the data which is provided by the company. And of course there are independent stakeholders who play a part in preparing that as well. But if a company is very forthcoming with its information and if they're able to provide it quickly, you could look at a listing in 6 months time.
Okay.
And how crucial is the investment banking's role, sir, in this whole process? Because you are coming from an investment banking perspective.
Yes. See, investment bankers are basically the advisors, people who handhold the entity and its promoter, right? I mean, a lot of times people are misguided. A lot of time wrong advices are given to promoters. A lot of time, see, capital markets, as I say, there are all kind of participants in capital markets. There are the good, clean guys also. There are people who have their own vested interests and they don't give the right or the best of the advice to the promoter. So a good investment banker will always speak what is right. Sometimes it may not sound sweet. Sometimes, it may, in the short term, the promoter may get an impression that it's not in the best interest of the company. But the right advice will always take the company over a longer and a cleaner, sustainable growth trajectory, right? For example, a lot of times there are people who give certain kind of wrong valuation expectations to the promoter, right? Which I believe is not correct, right? I mean, whether one gets a business or not, one should always tell what is doable, what is certain, what is possible, right? Rather than building any wrong hopes and then not delivering on them, which definitely strains the relationship amongst the participants, and it doesn't serve any good to anyone. This is what I've seen. So I think it's very important to be clean and transparent from day one, because a promoter eventually will figure out, right? I mean, when he's starting the journey with you, from day one, if you are clean, transparent, when you have explained him all the pros, cons, all the advantages, disadvantages, it would go a long way in building the trust and the relationship with him, right? Because he would know that you have explained him everything, and what you told them at the beginning is kind of panning out, right? So in that case, he doesn't kind of doubt you, or he doesn't think that whether you are trying to please him or not. That goes a very, very long way.
Yeah, it builds a goodwill in the long run.
100%, it has to, and that is how businesses should be, right? That is how you are taking a company which is private to public. You are trying to advise them, right? I mean, obviously with the help of the entire ecosystem, the entire merchant bankers and the lawyers and the IRPR firms. The point is, if you don't give them the right advice, who would? The promoter has always run the company in a very, closed door setup, right? I mean, he would not be knowing anything about, how the capital markets work, how would the compliances work, how would the governance structures work. He knows his business. He knows his business very well, which he has built, but he doesn't know anything apart from that. As the right advisor, as the right guide, it's your role to see that the promoters are made aware of all the advantages and maybe any possible disadvantage, all the pros and the cons in going about the process, the right time frame it would take, the right cost structures it would take, and the right expectations regarding valuation. They cannot be expecting more than what is fair, and they should not be fleeced on the other side also, right? I mean, so it has to be a fair win-win game for the entire ecosystem. So investors have to get a fair deal, promoters have to get a fair valuation, and the entire participants who are trying to do that for the company, the merchant bankers and the lawyers and the the IR agencies and the advisors, they all have to be rightly compensated. So there is a very thin line between what is fair and what is beyond fair. We should always be a few steps before what is fair.
So just to add into what Sir is saying, at the end of the day, what is the reason for taking any company public, right? This is the most basic question that comes to mind. It's about creating value, whether that's value for the company itself, whether that's value for the investors, whether that's value for other retail participants in the market who invest in these companies. And when is this value created or unlocked? It's when the advisors or sort of the investment banks that assist you in this entire process have the right intent in terms of valuations, for example, in terms of everything else, not just valuations, but your regulatory compliances, assisting the company in a strategic sort of way over the next couple of years, helping you plan your growth, giving you the right advice even if it sounds wrong in the near term. So to unlock all of this value, investment banks play a really important role in how they guide you. It could absolutely create a lot of value, or it could destroy the existing value itself. So investment banks, have a large role to play in sort of how well a public issue is managed, or how a company does after listing also, for that matter.
Yeah, and I feel the right guidance and the right ethics is even more crucial at this inflection point of India, where we are seeing such a boom in the SME market, and every other company might be motivated to see how their company performs on the stock exchange, and them coming to you with all the excitement. At this point, it might be very tempting for a lot of investment banks to just take the business, for the lack of better words, but telling them that probably this is not the right time for you to go public is what matters the most. Sir, I also want to understand, how does it differ? Say company A has raised capital only from the Indian set of investors or institutions, and company B has raised money from Indian investors but also has some foreign backing. So is there a different approach that you follow for company A and company B when they have to go public, or it's the same?
No, I mean, going public has nothing to do with what their existing set of investors are. When you go public, what are the kind of investors you are attracting is what matters. So when you are going public on the SME platform today, you would not see too many institutions participating, right? But you would have definitely participation from HNIs, ultra HNIs, family offices. They are very, very active today in that space. But as far as the institutions are concerned, let's say the mutual funds and the insurance companies and the FPIs, you would normally see their participation. You would largely see their participation on the main board, for the main board IPOs.
Yeah, and I would also say, SMEs is on the path to sort of attract that kind of global investment from, or we're a while away from it, no doubt. But the pace at which it is growing and what sort of prominence it has gained in the last 5-6 years, it is very well poised for foreign investments in the years to come. In fact, there are some relatively small funds which already participate in the SME market as well. But like Sir said, the biggest of the biggest funds, fund of funds, for example, they are always going to participate in more so in the main board category.
You think after setting up Gift City in Gujarat, this is going to increase the influx of foreign investment in India because it's going to be easier?
Well, ideally yes, because that's the entire intent of attracting capital, from overseas easier and seamless. And I'm sure over the next 4, 5, 6 years, money coming through Gift City in the country for various projects, not only in capital markets, would be much higher than what it is today.
Okay.
I guess that's a very, very right step.
Guys, you all mentioned about creating value not just for the company promoters and shareholders, but also for the retail investors. and what is, how important it is for retail investors to start creating a good investing behavior. Every household of the nation, whether it is 500 rupees to 10,000 rupees, one should now start believing in our country and with the right integrity, right? And start investing. What is your view on this?
Yeah. So see, amongst all the asset classes, right? I mean, if we divide asset classes in equity, debt, real estate, commodities, primarily gold, I personally believe, and I have a right to be wrong, that equities will be the largest asset creator, largest wealth creator as an asset class over the next decade, right? But how do you play it? If you don't understand this asset class, you can just go and buy a piece of gold, right, from the jeweler, or you can simply go and do an FD or your savings in post office, right? Those are simpler ways of parking your money. But equity is a very tricky game. It's not an easy game, right? I mean, which company to buy, what valuations to buy at, what time frame to hold on to, how do you know there is value in this company, how do you know the valuations are at peak, whether you should go direct or not. And that is the reason that every single retail investor entering the market has not been able to create value sustainably for himself or herself. I would suggest, so while I am a very big proponent, while I am a very big believer that a large part of the country should be having some portion of their savings in equities, but I definitely not recommend many of them to directly come in equity markets for the simple reason that they don't understand. See, if they burn their fingers, the problem is they come, they test the waters, they burn their fingers, they go back, and they don't come back for another 5-7 years, and by that time the country's markets have gone to a different level altogether, right? Just to give you some numbers in context, US on a 26 trillion plus GDP is having a market cap of north of $60 trillion, right? We are at a GDP of 3.5 trillion and our market cap is 4.2 or 4.3 trillion dollars. As the country moves to $6 trillion of GDP, market cap 100% has to go from here. How much we don't know, that's for us to hazard a guess. But as the country moves from 3.5 to 6 trillion in GDP, market cap will grow. A lot of companies will participate in that growth and see their valuations grow. But which one will not? How do you differentiate a copper from a gold? It's not so easy, right? I would always recommend the retail investor, the smaller investors, to go indirect route. Now, indirect can be again active or passive. You can put money in some active mutual funds, or I would suggest an even better way is to go passive. Participate in equity markets, but be a passive investor, buy some ETFs, and sit quiet. End of the day, if the country has to grow, if the capital market has to grow, the benchmark indices have to give returns, right? At least be happy and contented with those returns rather than playing and burning your fingers. What's happening in options market is something very, it's very surprising. I don't know how many of them are net making money, net taking money home, or they are losing, or it's become more of a hobby than an investing process. So I would say that, larger set of retail investors must come in the market. But I would sincerely recommend first few years they should invest in passive instruments, right? Especially the ETFs, right? I mean, a Nifty ETF.
So avoid quick gains and look for more sustainable routes of making wealth.
Definitely avoid quick gains, especially if you don't understand the game. See,
and
you
avoid
have to first of all master the game.
Avoid speculation,
100%,
right?
100%. See, end of the day, things like quick gains, speculation, they end up destroying families. And because the mindset doesn't become the right mindset, then you are having a wrong mindset, right? Then you are not thinking of capital market as a place which can grow your wealth. You are thinking of capital market as a place where you get in, make some quick money, get out. That is not the entire intent. The intent should be when you do an FD, you don't go and stand outside the bank every day, right, to see how much your interest has gone up or down, right? Similarly, suppose you buy gold, you don't go and check the gold prices every day. Similarly, it should be the idea, but then how can you do that? If the retail investor goes and buy a particular security on the market, any company stock, without even understanding that company, obviously every day, 5 times in a day, he or she will check the price of that security, right? But if you go passive, you simply go and put your money in a index ETF, you can simply be rest assured that let's say underlying capital markets overall market cap grows at 12, 14, 15% CAGR, at least some part of it or a good part of that growth in percentage would be reflected in the growth of the underlying indices also, right? So at least that much you are a participant.
Yeah.
If Nifty has given 10.5, 11% CAGR in the last 20 years, there is a reasonable possibility that in the next 7 years, as market cap goes from $4.5 trillion of the country to 7, 8, 9, 10 trillion dollars, the indices will also give at least 9, 10% CAGR.
Yeah.
Over a period of time, that is good wealth generation.
Yeah.
Compared to, let's say, a plain debt instrument. And then the beauty of capital markets is that, these investors who will stay on for a longer period of time, whenever they are able to sell their units or stock or whatever, the country's tax regime is very benign, so they pay only 10% plus a charge as capital gains tax. So end of the day, they will see a substantial wealth creation. But the point is they have to invest in the right way. They cannot be buying options or they cannot be investing in any security without understanding the underlying fundamentals and valuations and invest and then lose money and then crib. That is not the right way, I think.
Just on this point, in terms of statistics, about how Hemant sir mentioned about the United States. Today in India, there are roughly about, you can say about 14.5 crore Demat accounts.
Mm-hmm.
That means, and out of which about 8 crore are unique. So you can say 8 crore people have invested at least once in their life, right? Whether how active they are or not, we don't know. I mean, how much participation really is there probably comes from a lesser share of that, of those 8 crore Demat accounts. If you compare this in the US, about 60% of the people invest in equity markets. The population of the US is about 34 crore, around 340 million. And 60% of that is almost 15 to 17 crore people who are investing in equity markets in the US. In India, when you compare that number, we are not even at 6%. So participation, of course, has increased, like I also mentioned about the SIP.
Yeah.
So SIP growth also has been tremendous, but we are still far off from the real potential of this country has still not been unlocked. We are just scratching the tip of the surface, you can say. There's a lot more to come when retail participation increases and in the right way, like Sir said. So retail participation doesn't mean that you invest in a particular stock because of hearsay. At the end of the day, it has to come from your own understanding of the business. And what they say is that if you have conviction in a business, if your own conviction is there in a business, no matter what happens to the stock price, you will remain invested because you truly believe in the business. If you invest just because of hearsay, tomorrow that particular stock falls 5%, 10%, 15%, you're going to sell it off. If you do it based on your own understanding of the business, that 5%, 10% fall in the share price is not really going to change your view about the company. So investing in the right way is very important, and I think retail participation will increase over time, but they have to be guided the right way. They have to be told how to enter Indian equity markets, and that sort of awareness is, I won't say it's lacking, but it has to be developed more.
See, price increase, everything is very rosy when someone makes money. But these are capital markets, these are equity markets. One has to always be cognizant of the fact that there are drawdowns also, there are corrections also. Sometimes they are very sharp. There are bear markets also. And when value comes down, see, sustainably markets will always go up. But when these phases come and value comes down, it's very painful at times, right? And for the uninitiated, it becomes double whammy, right? They don't even know whether to stay on, whether to exit, whether to book loss. And then it's not a very good experience, right? And that's why I say participate, but it has to be in the right way. Because a lot of them would not have seen what a bear market is. They would not have seen what a sharp correction is, right?
So dip your toes before jumping in the water.
Yeah, and definitely no leverage. Today youngsters, they don't understand. See, what is F&O? It's leverage, right? Right? Never. I mean, so first of all, there's a lot of room for financial literacy, for capital market literacy in this country. Sometimes people fear, they don't enter out of fear because they don't know. If they enter the wrong way and then they burn their fingers. So capital market literacy is a very, very important need of the hour, because we have to make them participate also, and participate in the right way, so that they don't burn their money, they grow it sustainably, slow and steady, but grow their money. But they have to be in the right instrument for that. Right? They can't be in wrong instruments, which is what a lot of youngsters are doing, which is actually making me a bit jittery about what they are doing with their money.
Sir, I've noticed that sometimes when the company is listed, their stocks or their shares are only available in lots. Why is that so?
So this happens on the SME segment. When an IPO comes in an SME segment, lot sizes are assigned. On the main board, the companies can trade in lots of one share. They can be bought or sold as one share each. On SMEs, lot sizes are prescribed, so that because these are smaller companies, right? I mean, investors should know the risks of investing in such companies. Not every company in that segment will go on to create value or to grow their business, right? And hence, it's very important that investors with a certain minimum allocation come in. So the lot size is such that typically at the start, one lot is the value of one lot is less than 2 lakhs typically, right? So let's say 1600 shares into 80 rupees or 92 rupees or 1200 shares into 100 rupees. Each lot is prescribed at the start, even before the IPO. In that lot, multiples subscriptions are done, and trading also happens in that lot multiples, unless the market caps moves up substantially and exchanges revise the lot size. But till the time they remain on the SME platform and not migrate to the main board, they are traded in a certain predefined lot by the exchange.
Okay, so the exchange determines the lot size.
Exchange determines it.
And also, I think, sir, if I'm not wrong, lot sizes reduce as market cap.
Yes, as I said, yeah, as the market cap goes up. But again, it is exchange to decide that. It is for the exchange to decide.
Yeah.
I have a simple ask for you. Can you share us some of the technical jargons involved, so the audience, watching this can understand it in a very simple language? Like, what is a rights issue? What is a share buyback? What are dividends for the shareholders? If you don't mind sharing your...
Sure, absolutely. Yeah. Why not? So, sir, dividend is the return which a company gives to its shareholders out of the profit it earns. So, for example, let's say a loan attracts interest as a return. Shares attract dividend as a return. So, shareholders, so let's say a company in a year has earned 100 crores profit, and the management decides to return 10 crores out of that 100 crores as return to the shareholders. So assuming the company has 1 crore shares outstanding, total paid up share capital is outstanding number of shares is 1 crore. So let's say 10 crores divided by 1, 10 rupees per share dividend gets paid out to the shareholders at the end of the year. I mean, post the AGM, post the decision. A lot of companies give it annually. Few companies give it quarterly as well. So the timing the management has to decide. But this is one way of rewarding the shareholders out of the profits which a company earns in a year.
And what about rights issues, buybacks?
A lot of time a company has been earning well, but it has not found avenues in short term to deploy that surplus. So instead of keeping it in the company and deploying it in fixed rate instruments, at times the management decides to give it back to the shareholders. So as dividend is one form of returning capital, this is another form of returning capital to shareholders, wherein a company launches an issue called buyback, wherein it buys back its own shares. That's again done in two forms. There is a tender offer, and the second one, it over a period of time, in a predefined time period, it buys back from the exchange its own shares. And this is how the investors get money back in case they wish to surrender their shares to the company. So that's that. So apart from dividend, this is another way in which companies return back their surplus funds to the shareholders. Apart from returning the surplus fund, what it does is that it reduces the company's share capital, right? So a lot of times it's a very positive signal to the market that not only we are returning our surplus capital to the shareholders, the reduced capital, if the company continues to do well, helps in increasing the future EPS also of the company, right? Because the outstanding number of shares has been reduced. EPS is earnings per share, which is basically your total profit divided by total number of shares outstanding. So as the number of shares, if the denominator shrinks and the numerator increases, which is your profit keeps on increasing, and you have reduced the number of outstanding shares by buying back a part of it, your EPS naturally grows faster than how it would otherwise.
So right now there's a euphoria around the whole SME market, and a lot of investors, retail investors, are excited to participate in this bull run. Are there any pitfalls that a retail investor should look out for or avoid in this space?
Yes, of course. See, SME as a segment has done very well over the last, let's say 4 years. The entire market capitalization of all the companies on the SME exchange has become more than 10x during this period. The existing companies have also grown, and lot many new companies have also come on board. There is no denying the fact that there is froth in this segment. If this market cap growth is backed by the earnings growth, or let's say near term earnings growth, it's still okay. But I personally believe that you would see many names where the market cap growth is not correlated with the possible earnings growth, the current earnings growth and the near term earnings growth, and that is where my worry is. And these are the segments where actually some of the small investors burn their fingers, because if they are investing without understanding about the company, promoters, underlying industry, balance sheet, leverage, they are bound to make losses. Because I would say probably many of them will not do as well as people expect them to do. Right?
Why do they even invest in this company, sir? Why do you think the retail investor gets in that zone where he wants to confidently invest in these companies?
Simply because they are seeing the price on the screen, right? I mean, they are seeing the price going up every day. So it's just that, that greed of making quick money, which we discussed a bit earlier.
Is it like fear of missing out also?
Either probably FOMO, or the greed of making quick money, making a quick buck, right? Enter today, exit in 5 days, make your money. The point is, when they get stuck, when the cycle turns, when the tide reverses, then in many of them, they won't get exit simply. So again, here I would recommend that it's not that the segment is bad. There would be gems coming from this segment. There would be companies coming from this segment which would do extremely well. Some of the companies from this segment have migrated to main board and have created substantial wealth.
Multi-baggers.
They have been multi-baggers, more than multi-baggers. I think they've been sustainable. Growth per se is I'm not a big fan of multi-bagger, but the multi-bagger has to be sustainable multi-bagger. Like, it can't be a 20x and then 80% drawdown, 80% down from there, right? That is no growth. Growth has to be sustainable. If it's a 20x, then it has to remain 20x for a certain period of time, right? I mean, and then probably further consolidate and further grow from there, not like zigzag coming down and all. So my point is that while the segment will produce gems, but I have my own doubts with if majority would be gems. I am in the camp where I believe that a small minority will be gems coming out of this sector, and a good part of the companies will not create sustainable wealth. And hence I am worried about retail investors closing their eyes and just putting money like left and right in these companies, because over a period of time, by the time market is a weighing machine in the long term, right? It's a voting machine in the short term. So by the time markets start weighing these companies, a lot of them will come to their right place. And hence again I will recommend here that possibly going direct is not an option, but the problem is that to go indirect also they have to go through some of these platforms such as PMSs and AIFs. But then again, there the cutoff barrier is high. They can't put a few lakhs and participate through these platforms. Even these platforms will make mistake for sure. It's not that every PMS manager or an AIF manager is the smartest guy and he is investing in the right name. But at least they are doing their homework. At least they have built a research desk in their organizations. At least their entire team is going, meeting the promoters, analyzing the balance sheets, understanding the ecosystem, doing their own dipstick check. So the possibility of them making losses will be definitely lower than the average man on the street.
Yeah,
that's one way. Second is that I will still say that there is absolutely no point in just having the herd mentality, because at the end of the day there are situations where the entire pack of herd goes down the hill.
Yeah.
Right? And I think that is what is happening in this segment, which is actually making me very cautious. See, it's not that I'm not optimistic about this segment, right? I mean, I know there are very good promoters which are wanting to come, and there are very good companies which will list in the next 12 to 18 months, and I know they will create a lot of sustainable wealth. But what I'm worried about is the way this whole euphoria is panning out, that a stock lists and it just keeps on doing back-to-back circuits, and the market cap suddenly doubles in a month or so, or trebles in a couple of months. Post-listing, the listing itself is much higher than where the IPO came. So what suddenly happens that from the time of IPO, the stock is 5, 6, 7x in a period of 3, 4 months, right? Which is actually making me think that you should enter. Either you have to enter at the initial stages, right? I mean, if you study, there's a company coming to public, you're studying all their DRHP, you're studying the balance sheets, you've gone and met the promoter, you visited their plant, or you've done a little bit of scuttlebutt, you come on day one. Entering at the peak of the euphoria, entering at the top of the valuations, and then see it fall down substantially. I think that is not the right recipe of investing. I think that is a recipe which at some point of time will make you go away from the market and not help you enjoy the fruits of sustainable wealth creation, which this market will certainly offer. Again, I'm telling you, we come to the same point that markets have to be played in the right manner. Market will create a lot of wealth, but not in every pocket, not in every entity, not in every form, right? So it has to be played in the right way. Unless you are an expert, you are a subject matter expert, unless you understand those underlying companies, then you do what you want to do. But if you are not an expert, if you don't even know, just catch any investor who's invested in an X company, let's say X SME company, and ask him what is the net worth of the company, what is the revenue of the company, what is the EBITDA margins, PAT margins, debt equity, debt EBITDA, ROC, ROE. I am sure a bulk part of them will not be able to answer any of these questions, right? This is not the right way, is what I'm just trying to say. So that is where the education concept comes, that they have to told how to participate in the right way. Somewhere they'll falter, they'll make mistakes, and then they go back. We don't want people to go back. We want people to come and stay in capital markets, right? And create sustainable wealth for themselves.
Play the game right.
When such an euphoria happens, markets become very speculative in nature as well. So, somebody is entering at the top of entering a company at which the valuation has already peaked. So these are the kind of things which people are unaware of. What happens to a retail participant is that you track a particular stock, you see every day it's hitting upper circuits, it's 5% up, 10% up, every single day for a consistent period of time over 2 or 3 months. And at some point when you keep seeing that stock go up, you never can truly figure out what the right time to enter that stock is. So you're just buying it when it is going up. And that sort of investing, I would say, is what puts people away eventually from markets, like Sir said. So, having said that, I also am of the opinion that given India's growth trajectory and given India's development across all sectors, whether that's infrastructure, whether that's commodities, textiles, mining, all real estate, every sector, India is looking at a decade-long bull run. But when I say that, I have to be very careful when I say this also, that when I say a bull run in companies which will... So what happens in a bear market, right? Like there's a correction that happens and companies in which there is high conviction will always remain. Those will continue. So when I say bull run, the bad apples will always come out. But companies with high conviction or with high growth, which have really strong fundamentals will be supported. And there is less speculation, I would say. So it's very important that a retail participant understands all of these things before they come and invest in the SME segment particularly.
And it's very important because, like, for everyone listening, I think you will not only be doing a disservice to yourself by losing your money, you'll be doing a disservice to the entire nation by not investing in the India story correctly. So make the informed choice by making sure that, like, whatever investments you're making is an informed one, not just a speculative one.
Absolutely.
So guys, at Galgal, we're trying to, inculcate good savings habit, and, we're trying to create easy habits for easy money. And on a personal note, sir, you've seen, the whole life cycle from starting from scratch at a bank to now having your own investment firm. What advice you have taken in your journey of savings and investing that you would like to share with us that has helped you? And also, if you want to share some mistakes that you've done that, we learn from, and how can one focus on their personal wealth is something I would like to understand from you, and hopefully we take it out from this episode.
Sure, absolutely. See, I am a very big admirer of capital markets, equities, right? Except my house, most of my personal net worth is in equities, right? But as you rightly said, it's not been done in a day, right? I mean, it's taken years and years of sharpening my understanding. And even now, I believe that as a student, I think I have a lot more to learn. Having said that, I do largely direct equity investing, but I don't recommend that. Again, I'm repeating, I don't recommend that to an average man on the street, because you have to first understand it. My banking background helped me, my academic background helped me, right? All that helped me because I could closely see hundreds of corporates, the mistakes they have done, the good things they have done, how they have created value, how they have destroyed value. All that learnings has helped me become a better investor today, right? I would still say be in the equity space. If you are a new guy, if you don't have allocation in equities, go the passive route, go the indirect route for sure. Within indirect route, go the passive route, right? But be in the markets, but don't play with the fire. If you do it in the wrong way, capital markets can not create wealth also for you.
Yeah.
Right? They normally would, but you have to walk the right path. I directly invest in equity markets because I've been seeing them for the last at least 15 years, very closely. And that's why I can take that risk for myself. But I would not recommend an average man unless you are very confident, unless you understand, first of all, unless you understand balance sheets, unless you understand businesses, unless you understand, which industry would do well going forward. Within that, the specific company which you are analyzing, what potential it has, whether you understand valuations more than anything else. It can be a great business, but it may not be at the right value for you. Right. So be in equities is what I will say, but understand the path within equities what you want to take. Direct equity, indirect, within indirect, putting money in the hands of someone who is doing active investing, or simply putting your money in passive investing and sitting quiet and see the capital markets grow and your wealth getting created. That is one thing. In the next decade, in the next 7, 8, 10 years, lot more promoters, owners of so-called smaller companies, and by smaller companies we discuss companies less than 1,000 crores in top line and less than 1,000 crores in valuation today. Many of them will come in the capital markets, many of them will create, some of them will definitely create a lot of wealth, many of them may or may not. Many investors will be much more well off, much wealthier than they are today with significantly higher net worth. It's just about how do you play this game.
And Kunal, at such a young age, when you have been involved with capital markets, what are your financial lessons or takeaways that you would like to share with the audience?
So, see, I mean, to understand my perspective, I just want to give you a little bit of a background as to how I became literate about this market or how I understood capital markets. I'm very fortunate that, my family has been in capital markets for the last 35 odd years, 35 to 40 years. So they have seen times right through 92, 2001, 2008, COVID, and I have had a lot of learnings just listening to my father speak about these situations or how. So not everybody has access to that kind of information or learning from my father's experience. Although I have not seen any particular downturn yet, I am very well aware of the fact that after every good market, there is going to be a bad market, or bad times are going to come. It's about how well prepared you can be for those bad markets, and most important, the most important thing for that is to be literate about it, to read about it, to consume more and more knowledge about it, to watch. I don't know, it could be as simple as watching videos about it, or it could be about reading books about it. So the more knowledge you gain, more you consume, that will all lead you to sort of becoming more financially literate about these things, understanding how to invest, how to enter the equity markets. And like Sir said, you don't have to come in and directly invest into a particular equity. You can start with indexes, with being a passive investor in any kind of ETFs, which are exchange traded funds. So it could start right from there, and it could then you can slowly dive into particular stocks, particular companies. But it all begins with having knowledge and information about the same, which you can gain by reading, by watching movies on it, or any kind of fun activity which also includes knowledge regarding the markets is helpful to begin with. Additionally, I would like to say that what has also supported or what will support this equity investing is the digitalization of things, and how quickly India has digitalized or transformed itself digitally. It's just going to make access to investing much easier. So, and at the same time, that will give access to knowledge or to information that is being consumed. So digitalization really helps the whole ecosystem quite a bit. So I think we are at a level today where we are very well positioned. India as a country is very well positioned to educate, inform, give access to small retail participants to enter these equity markets.
No, absolutely, and I think the growth story of India is just starting, and we have the right tailwinds in place to take us to great heights in the near future. So thank you guys, thank you for coming and sharing all this information with us. I'm sure the audience will take a lot of golden nuggets out of this podcast, and I'm sure there will be a lot of actionables that the audience can find from this podcast and implement them in their life and grow their wealth.
Thank you. The pleasure was mine, and thank you for initiating something like this. I'm sure it will help a lot many new investors become informed investors before they come to the market.
Thank you. And I think the whole idea of having this conversation is just so that people become more aware, about what are the current themes, what are the trends, where the country is as a whole. And as long as it helps even a single person from the audience, more than happy to share whatever little knowledge I have in that aspect. So thank you.
Thank you guys
Thank you
so
guys.
much. Yeah.
Thank you.